The inverse Cramer tracker ETF. Total Capital Management has launched both the long Cramer tracker ETF, stock symbol LJIM, and the inverse Cramer tracker ETF, SJIM. These distinctive exposures allow investors to profit off a decline or a rise in the public recommendations of Jim Cramer. The fund's prospectus states that under normal circumstances, it will hold positions for no longer than a week and be based on recommendations from the show and on social media. Total Capital Management launched a similar fund that bets against Cathie Wood's ARK Innovation ETF and has outperformed it. Concern about the fund includes not being concrete and definitive enough on their trading strategy. If the fund only holds 20 to 50 positions, what determines something that stays or is sold? How do you define what is a call on Cramer's part even? The Tuttle Cramer ETFs are expensive at an expense ratio of 1.2%. Investopedia recommends expense ratios between 0.5% to 0.75% for actively managed portfolios. You can't control what the market does, but you can control what you pay in expense fees when you choose your investments. So who is Jim Cramer? Jim Cramer is a very polarizing figure. He is most well known for his show Mad Money, where he makes stock picks. He used to be a hedge fund manager and has ownership in TheStreet.com. He's controversial for several reasons. His stock picks can seem like they are based on personal bias and not supported with adequate evidence. There have been allegations of conflicts of interest due to his background on Wall Street and that he is self-serving with his recommendations. Although Cramer has had some successful stock picks, he has had quite a few stocks that have imploded. Some people say his show is overly produced for entertainment rather than sound investing advice. His soundboard gimmicks and his personality are childish. A 2016 study by Wharton students found that Jim Cramer's Action Alerts Plus portfolio returned 64.5% from 2001 to 2016 versus the S&P 500 returning 70%. Jim Cramer does not like ETF funds. He says, you want to be in a stock because it's the best name in a sector that's growing. You don't want to be in a group of mediocre stocks that will pull down the high quality stocks you've chosen. However, this is not investment advice. I would argue that passively managed index ETF funds are a safe and popular investment for people with a long-term time horizon because they provide diversification, low fees, flexibility, and transparency.